Welcome back to the Consulting Mind. Today I'm going to talk about the big topic, the quantitative tightening. And in particular, I'm going to share with you the big gap, the big dynamics between the market and the Fed, what they are thinking differently and what it means to your investment. And I'm going to share with you some tips to look for during the September FOMC meeting. And let's get started. So let's first start with the recap of the quantitative tightening implementations details. It was started at 1st of June this year, and there are two major asset classes that will be involved. The first type of asset class is treasury securities, and the initial cap will be set at 30 billion US dollar per month, and then after 3 months of execution, it will be double and increase to 60 billion US dollar per month. And for the second type of asset class or securities, it will be the mortgage-backed securities, the so-called MBS. And the initial cap will be set at 70.5 billion US dollar per month. And again, it will be double to the level of 35 billion US dollar subsequently. And then as a refresh and as a recap, let's talk about the two major types of quantitative tightening approach that the central bank can be adopting in order to reduce or to shrink their balance sheet. The first type is so-called the active approach, where the central bank will be going to sell their bond holding on hand in order to liquidate their bond portfolio. And under this approach, the impact to the market will be huge and larger because it will trigger more concern or even panic among the market. And it will cause a relatively large liquidity issue. And the second approach is so-called the passive approach, where the central bank simply let the bond holding reach the maturity. In fact, the Fed is also using this approach for now. While on the other hand, there is actually another central bank, which is the Bank of England, is going to adopt the other approach, which is the active approach. As you can see the capture from the news, that the BOE Bank of England is going to be the first major central bank to sell some of their government bond on hand that is being purchased during a decade ago, with a 40 billion pound sales program that will likely to be started in September. Apart from the quantitative tightening program in order to strengthen the Fed balance sheet, the Fed has also raised interest rate by 4 times already this year, and the Fed fund rate has already risen to the level of 2.25% to 2.5% at the FOMC meeting in July. And then the interesting things come. As you can see from the chart, the S&P 500 index not only did not drop because of the tightening liquidity or because of the uplift of the interest rate, it actually rise a bit at the bottom of June 2022. And why does that happen? It is kind of counterintuitive because suppose with less money in the market, especially there is both quantitative tightening with the shrink of the balance sheet and the uplift of the interest rate, it's supposed to be dropping. But why it does not happen the way it should be? We can try to go to the Fed balance sheet record to look for some hints. As you can see from the chart, where it shows that the Treasury securities has been trimmed down by close to 70 billion US dollar from early June to now, which is actually quite mapped with their schedule at a reduction pace of 30 billions per dollar. So 2.5 month will be close to 17 billion. So basically, for the treasury, it has been trimmed down per the schedule. But when we look into the mortgage-backed securities holding record, it tells us a different story. As you can see from the chart, the MBS holding record by the Fed is actually fluctuating across this month. It did not go down or being trimmed down per the defined schedule. Actually, it has been rise a bit, in fact. So how and why does that happen? And what did Jerry Powell say about that? As you can see from the press conference that Powell has mentioned, he thinks that the quantitative tightening program is working fine. And in September, they're going to go full strength. And the market seems to have accepted it, he perceived. and by all assessment, the market should be able to absorb this, and he expects that it will be the case. So he thinks that the bond reduction program is broadly on track, and sometimes it's going to a bit slow because of some trade that's not being settled for some times, but it will be picked up. So the biggest takeaway from the previous sharing is that the Fed is going to go full strength in September. If it is the case, then the market is actually betting against the Fed. So I'm going to share with you another news as below. Mary Daly, another key person from the Fed, who is the San Francisco Federal Reserve president, commented that she predicts the Fed is going to continue the rate hike at least in next year. But that's ultimately a good thing, and even though Wall Street investor doesn't see it the way it is, and there is a lack of understanding in the markets. And also, a raise and hold strategy has been historically paid off for the Fed. So, if you have been watching the Fed fund rate expectation carefully as predicted by the market now is actually expecting a rate hike in this year, by the end of this year. And then it will fall back to a rate reduction by next year. So the market now is actually betting the Fed might be going to continue the tightening in this year, but they will eventually going to cut the interest rate again, or to stop the quantitative tightening program again next year, because in order to save the economy, in order to prevent the economy from going to recession, and they are also betting that the inflation might be in control. And then we can see what another Fed official, who is Thomas Bacon, said about this. He said that the central bank will do whatever it takes to return inflation back to its target, and even this will mean risking a recession. So this is exactly where the dynamics between the market and the Fed. The Fed show its strong intention to curb the inflation, even though it might risk the economy going to recession. But on the other hand, the market is not believing that, and they are betting that the Fed will going to give away for the possibility of the market economy recession. So this is the key, or perhaps the biggest dynamics or the issue that you have to take into consideration when you are making the investment this year. And if you are with the same side of the market, and you should be watching out the risks when your betting might not be the case. So this is all my sharing today. If you like my channel and the topic, please click the like and subscription button, and see you soon.